Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani here. I hope the market's treating you well and you're able to navigate through the traffic of the market much more better after watching my videos. Day before yesterday, I recorded a video about how you should not be unduly worried over a long period of time over the Russia-Ukraine war. Of course, in the near term, there would be volatility, there would be knee-jerk reactions, and leverage positions would get cut, and the fact that a whole lot of people who've entered the market only 2 years ago, or maybe even shorter than that, they are experiencing a decline in the market for the first time, and they could even accelerate the fall. And I also told you about the geopolitical fact that Vladimir Putin has taken upon himself the role of a historical unifier of the splintered states of the erstwhile Soviet Union. So, the war may or may not last long, but I can assure you the problem in Eastern Europe is not going away all that soon. Will Putin make fresh demands even if he gets or does not get Ukraine? I am anticipating that. There are other Balkan nations, Latvia, Estonia, Lithuania, the other Baltic nations that he might be interested in. So this is a long-term festering problem that's not going to go away all that soon. Does it mean we stop investing? No. Does it mean life will come to a standstill? No. Is there any alternate avenue or even an avenue known to us in the financial market which we can use to deploy our funds so that we can get by with above average returns? Yes, that's what I'm here for. And to my veteran watchers, my viewers, I've discussed this somewhat 10 months ago, and to our new subscribers of the Equity Master YouTube channel, this will come as a breath of fresh air. I am talking about the Nifty ETFs or exchange traded funds. Now, what's an exchange traded fund, particularly a Nifty exchange traded fund? These are delivery based stocks purchased by a fund manager exactly in the proportion of their weightage to in the Nifty 50. So if a stock has a weightage of 10.1%, the fund manager will allocate 10.1% of the capital in the ETF. Why? So that it mimics, the ETF mimics the percentage movement of the Nifty itself. Why is Nifty ETF something that I choose to recommend time and time again? Because it is a proven market outperformer as compared to the mid cap, to the small cap segment, especially when the markets are in a decline. Now, before I proceed, a caveat here. As a matter of fact, a couple of caveats here. Number one, I am not recommending a short-term trade. Remember, this is an investment. Number two, when I talk about outperformance, I mean that the instrument will fall just as the entire market falls, but it will fall lesser. So if the broader market is falling, say 3%, the instrument falls less than that. And if the broader market is rising 5% and the instrument rises more than 5%, that's outperformance as well. That is how mutual funds calculate their NAVs and get boasting rights every quarter when they insert their advertisements in the press. Alright. So this instrument is built, the way it is structured itself is built to outperform the broader markets. I'll explain to you why. You see, the weightage of the stocks that comprise the Nifty is telescopic in nature. You remember in the olden days we used to carry pocket transistors with helical antennas. Alright, now those are telescopic antennas. They can be extended and they can be compressed. So the weightage of the stocks that comprise the Nifty 50 are telescopic in nature. If in a month A, say for example month of February, a particular stock XYZ is gaining, in the month of March, the weightage of that stock will go higher. And in the month of February, if the price of a stock ABC has fallen, in the month of March, the weightage of that stock is automatically reduced. So the way the Nifty ETF is built, which is to mirror the Nifty itself, the Nifty itself is made so that it does not fall much when the broader market is falling, and it rises more when the market broadly is rising. Because the weightage of the gainers is raised and the weightage of the losers is reduced. Now, I want to discuss one more point of view from the statistical aspect of the market. You all know me as somebody who believes in statistical trading models. You see, when you see the composite stocks of the Nifty 50, there is a study called the correlation coefficient. Most of these stocks have a positive correlation with the Nifty 50, which means they move in the same direction that the Nifty does. If the correlation is negative, means the stock has a tendency to move in the opposite direction, or there's an inverse relation with the Nifty. So the Nifty is going up, the stock is falling. The Nifty is falling, the stock is rising. That's inverse correlation. The composite stocks of the Nifty currently have a positive correlation, and the correlation is in many cases higher than the broader Nifty itself, the total Nifty 50 itself. Obviously, some will have a higher correlation, some will have a lower. Everybody cannot have a 1:1 correlation. So what really happens is that the Nifty is not half as volatile as your individual stock is. It is, compared to individual stocks, relatively speaking, remember relative, rock solid. Now I have found through my statistical model that an average F&O stock on the NSE derivative segment has an intraday volatility ranging between 3 to 3.75% day to day. The Nifty, on the other hand, has a day-to-day intraday volatility of no more than 1.5%. On some days, of course, 2%. Average. We are not talking about exceptions. We are talking about average. So, you can see that the Nifty is relatively a lot more stable, which means it will fall less than many of these stocks. And like I said, when the overall market is rising, not only does the tide lift the Nifty ETF's boat, but it lifts it higher because of the telescopic composition of the weightages. I also discussed in my past video as to who is betting their money on the Nifty 50. Does it make a difference? Yes, I think so. If strong hands, if big hands are entrusting their money to the Nifty 50 ETF, I think that tells you something. You will be surprised to know that most of the money of the EPFO, the Employee Provident Fund Organization, and the Sarkari Babus, their retirement money is in the Nifty ETF. Of course, money keeps shifting as per the value of the Nifty. There are redemptions and there are additions, etc. So, approximately 2 lakh crores. 2 trillion rupees are invested in the Nifty ETF collectively. Various schemes, but collectively. I don't think anybody has any doubt that an average bureaucrat is extremely savvy about handling his money and he does not invest to lose his money all that easily. Hey, so if these guys are trusting the Nifty ETF, what are you waiting for? Can it provide you protection during turbulent times like the ones right now? Yes, I would bet so, because I have been recommending this route of investments since a very long time. My veteran viewers will recollect that. Secondly, the composition of the stocks don't change unless the composition and the weightage of the Nifty itself changes. So it is a low cost index fund alternative. This is like a proxy of the index, and since the index is not changing, the fund manager does not buy and sell too much and does not pay too many execution and commissions and costs. So the expense ratio tends to be lower, which means you as an investor take home a higher percentage of the profit. Remember, this is a long-term investment, not a short-term intraday trade. So do keep nibbling onto it. Those of you who bought the Nifty earlier have rode that train on the way up right from the value of 12,800 odd levels when I recommended the Nifty ETF first. If at all you're getting the Nifty at sub 16,000 levels, the ETF forms a bottom below that, I think it would be a good time to start sinking your teeth and taking a bigger bite onto the Nifty ETF. Split your money into 2 or 3 parts and start allocating it on declines. Don't worry about the short term. This is a long-term investment. On this cheerful note, my friends, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment section, good, bad or ugly, I'd love to hear from you and what I should do in my next video for any queries that you might have. Also, let me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. Stay safe, stay well, look after your investments and your health. This is Vijay Bhambwani signing off for now till we meet again in my next. Have a very, very profitable day. Bye-bye.